Chat with Traders, episode 110.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
Guys, I'd like to introduce a new and a really cool sponsor this week. That sponsor is Gemini. So Gemini is the world's first fully regulated and fully licensed Bitcoin exchange for individual traders, investors, and institutions. Gemini have the security technology and regulatory oversight to provide a safer and a more trustworthy place to buy, sell, and store Bitcoin. For much more info and 1 month's worth of free trading, head to gemini.com/traders and register. That's Gemini, spelt GEMINI.com/traders. Also remember, I've struck up a deal with Edgewonk. This is something that's ongoing. Edgewonk is a brilliant journaling tool built specifically for traders. So if you go to their site, you can actually see a full list of all the built-in features that will help you to track important trading metrics and analyze your performance. A lot of really essential stuff. To find out more and purchase Edgewonk, visit edgewonk.com and use the coupon code TRADERS to save $20. Edgewonk is spelled EDGEWONK. What's up? How are you doing, team? First up, I hope you've all had a chance by now to listen to the previous episode, which was my interview with Edward Thorpe. I mean, the man is a real-life superhuman. He has such an incredible story. If you haven't heard it yet, please make sure to check it out. Now, anyway, on this episode, I'm joined by George, who also goes by @RollyTrader on Twitter. George is an Australian equities trader with a momentum/swing trading type of approach. In the past, George has held a few finance-related positions, but since late 2009, he's mostly been trading independently. During the interview, George and I got speaking about lessons he learned early on, the effect that coaching and mentoring has had on his trading, specifics about the setups that George trades, and also his involvement with venture capital, which was pretty cool to hear about. And as we do get quite specific on trading setups during the interview, I just want to give a friendly reminder, and that is you are entirely responsible for your own trading decisions. Please remember this, guys. And that's it from me. Please welcome George for episode 110.
Just shutting down now for a public holiday tomorrow, so just running through a few charts for Friday.
Excellent. Yeah, we've got Australia Day tomorrow. Any plans?
I am having a couple of people over here, so just with the family, with the children. Nothing too exciting.
Good stuff, man. Good stuff. Well, I'm also pleased to say that you're my first guest after however many episodes, 100 and something episodes, that's from New Zealand originally, although you're also living in Australia now like I am. But yeah, very cool to have someone else who's from New Zealand on the podcast. Finally, I knew it would happen one day. So tell us a little bit about yourself. How did you get interested in trading? When did this sort of start for you?
I guess I was introduced at a pretty young age with just with the family at home. We used to have a sort of a trading competition when we were about 4 or 5 years old. I have a brother 11 months older than me, so we're pretty competitive, and Dad gave us $1,000 in the account, and we'd sort of go through the newspaper every morning, and which was a day delayed, the data obviously, and pick a stock, which normally would be one that sells ice cream or something you'd know, and we'd track the prices. And I think that probably at a young age installed an interest. And then after university, during university, really got into it. So that was 2001. So it was an interesting time in the markets there to start sort of learning and going through everything. And then I've really been sort of full-time at it since then.
Excellent. So was your dad a bit of an investor himself then?
He was. He's certainly not a trader, or he dabbles in the stock market, but no, not as a trader, which I guess is sort of what I do today. He just has an interest in business, and probably sort of wanted us to have an interest in understanding value or perceived value.
Okay. And so I've got to ask, who won out of you and your brother? How'd the competition play out?
Well, I believe I won, but we'll let that be a debate for the Christmas table. But he got a little bit bored of cutting out the numbers and sticking them on the wall. So I don't actually know what happened to his account. It might have had a good compounded return by now if he held Telstra, the New Zealand teleco stock.
That's funny. So you said you got really serious about trading, a little later in life at university. What sort of things did you start doing? When you say you started to get serious about it, what did that sort of look like?
I had a friend who was a few years older, and he was trading, and he was a good rugby player and a very competitive person, and he just sort of, I guess, sold me on the idea that it was the ultimate game. And I'd always been interested, and I guess was learning about it probably more from the economic standpoint rather than a fluid market standpoint. And so I went and spoke to my father and one of his friends, and he said he knew someone who was a asset manager in New Zealand. He said, look, why don't you go and have a chat with him? He'll be able to tell you, how it really works. So I did that, and he put me on to a few books, which started at the Market Wizards, the first edition they did, and I read all them, and I guess from then on in, I knew it was for me, and the journey started. Just read everything I could, and I had an account open, but it hadn't really been doing anything, and you're kind of throwing darts. And I guess with the progression of technology, you were able to, for someone who wasn't 100% committed, able to start studying with real data rather than just reading. So that got me going. And then when I had the ability to put a bit of money into the account, did that, and then went from there.
Right. So how did that conversation go with the asset manager you spoke with in New Zealand?
Well, he basically said, this will beat you up if you try and do this, and this is what you need to focus on. And he said everyone thinks they're going to get rich quickly, but it's just not how it works. And if you have that mentality, you'll be refunding your account very often. And they were certainly more of a conservative, big fund manager. And so he said you need to firstly pick your style of what sort of trader you want to be. Do you want to be a conservative investor? Do you want to be fundamentals? Do you want to be momentum based, a day trader, currency, stocks? So, and I think a lot of people actually, certainly ones that I've helped or have seen over the years, they take too long to pick exactly who they are in the stock market, and it causes style drift, which I think is a really a big issue for traders in their first few years. They'll be day trading the index and then calling themselves a stock investor, or trading the Aussie dollar, and it just doesn't work. You've got to dedicate your life to one asset class, as far as I'm concerned, and maybe you'll be able to master that after a while.
So why do you think that style drift actually occurs in the first place?
I don't think it does with professionals. Certainly the people that have trained me don't. They trade one style or one asset class. Obviously it can happen in bigger organisations, but you'll normally have a specialist for each individual class. But I think it's people staring at a screen with lots of flashing lights coming at them all day long, who read a tweet or are listening to CNBC and hear, the Aussie dollar's going to do something tomorrow, or it's doing it now. And there's just that temptation to gamble, because, if you've got a trading plan, you won't be trading currency and stocks and commodities. Well, 99% of people won't be. The exception to the rule who can do it that's fine for them, but the market works on probability rather than exceptions. So, I mean, in my opinion, it's better to choose, at least narrow it down to a currency trader, a stock trader, and then you can hone in on your style.
So that would be sort of your advice for preventing or reducing the temptation of style drift, is to just pick one asset class and really sort of zoom in on that.
Absolutely. I mean, just the mental and emotional costs. I mean, I've made every mistake there is as a trader, so I can speak from my own experience. You'd be trading, the stock market, and you'd have your 5-minute chart maybe of the XJO or the E-mini or whatever it was up there, and you might see a trade which potentially makes sense, and all of a sudden you're day trading the index, and you can't be focused on so many things at one time. And I'd noticed that I would really just be making the broker money, losing a bit here, making a bit there, but all of a sudden I'd miss that one or two trades, which, would be the good trades in the stock account. So it's not what a newcomer to the stock market should be doing. And the temptation will be there. So one of my mentors always said to me, he doesn't even look at the index. He said, if you can't tell what the stock market's doing by how the leading names are acting, you shouldn't really be a stock trader. And I think that's very true. And I had to go through a period where I actually just shut off the index and didn't look at it, because there was just the opportunity to trade. It was too great. And once I stopped doing that, my results really started to turn, because all of a sudden I could narrow my focus down to one or two particular setups and just try to master them.
Yeah, okay. And I think the key word in your response there being focus, for sure.
Yeah.
Now, the asset manager you spoke to in New Zealand, you said that he recommended a few books that you read, those, of course, being some of the Market Wizards books. Do you remember what any of the other books were that he recommended to you?
The Livermore, the Reminiscence of a Stock Operator, and then the shorter book, I forget its name. And then I actually went from there and sort of found who these Market Wizards were, and if they had then gone on to write books. And a few of them had, so started reading them, and I guess got my style sort of based off the William O'Neill Can Slim model, and then that slowly progressed on to people like Mark Minervini and Gil Morales, who I guess have a slightly more refined and updated version, and that's really my exact style. I copied them, have added a few of my own little intricacies and adopted it for the Australian market.
Now, at some point, I presume we're probably jumping forward a couple of years, you actually picked up a job working at an investment bank. Can you tell us a bit about the sort of things you were doing inside of the investment bank?
Well, I was on the M&A side there, and we had a trading division, so I sort of found myself hanging around the trading division the whole of the day. We were in the corporate finance side, so when I moved back over to Australia, got on to an institutional desk at a firm here, advising a couple of institutions and writing reports for them. So I guess that's when it started to get serious, and that gave me a really good insight into how the big money moves, where they're buying, how they're buying, and why they're buying.
Right. And you said when we were speaking prior to now, you said that a lot of the people who were on the desk with you and who you worked with laughed at the idea, or almost laughed at the idea, of using charts. Can you tell us a little bit about the mindset there?
Yep. I think there was over 100 brokers, brokers would be the right word, and I think we had one technical analyst, and there was probably 15 fundamental analysts, and there just wasn't much attention paid to any of the work done there. And the firm was sort of a traditionally old Australian brokerage, where it was blue chips. There was a couple of small cap operators there who did this, but yeah, it wasn't. I never went to a morning meeting and heard anyone say, the sector's setting up, there's a whole bunch of names about to move, this chart's breaking down. It just wasn't discussed. And by that time, I felt reasonably comfortable trading with charts, and I just couldn't get over it. And especially through the GFC, when you could, it was pretty obvious looking at the charts that the market had topped, even if you're 3 months late on it, that you're in a bear market. And I just saw, so many people, not necessarily at that firm, but just wherever, just buying those first dips, buying the second dip, and they just got their head torn off. And it's just something that you can avoid, I think. I mean, you might get sucked in and trade a couple of the rallies back in, but the good traders wouldn't. The good traders made money in that year rather than lost 60 or 70%, which sadly happened to a lot of people.
So when did you decide to go out on your own, and when did you actually feel comfortable to make that leap, if you will?
I went out in late 2009 and traded for myself for a while, and then started trading for a private equity firm. And I was probably more lucky than smart, but was able to piggyback on the back of the gold equities run, and the rare earths were very strong sectors in that sort of 12 to 18 months. So we were lucky that we had a good couple of years, and then that allowed me to completely go out on my own after I'd done that.
Now, at some point during all of this, you had a mentor, which you've already kind of mentioned, Mark, how do I pronounce his last name? Minervini? Mark Minervini?
Yep.
He was featured in one of the Market Wizards books, I believe. How did he kind of help you out? How did you come across him? How did you get to know him? Tell us a little bit about how that came about.
Well, first, my wife and I, she was my partner at the time, we moved over to Argentina. There was a guy who I knew who had managed a fund for Soros for a while, and he was over there, and I thought it was a good chance to go and pick his brain. And we were starting to trade the US market, so the time zone worked. And while I was there, had made a list of the best traders that were alive, and sort of wrote them, letters or emails, or read their books, however I could get in communication with them. And the first one actually to respond was a guy, Mark Cook, who was also a market wizard. He was a day trader. And he responded, and so I went over to Ohio to see him, and he trained me up in I guess, day trading. He was just the most amazing day trader. It didn't fit my trading style, but certainly learning the discipline and his daily ritual and how he views the market, and almost the simplicity in what he does. I was still 26, 27 at the time. You kind of think there's this edge that potentially these big guys have that you just, you might not ever get, or you might not be able to get. And after that was a big turning point in my trading when I saw how he traded. It was just so simple, yet he will probably go down as, one of the greatest day traders of all time with an audited performance. And so that was a huge turning point for me. And then with Mark Minervini, it was the same sort of thing. Read his books, got in contact, and he said, look, we do, some programs once a year, or they just started doing them. So went over and did that. And I went back last year actually to see him, and they do services and stuff like that you can subscribe to online. But I think as a new trader, getting that early mentorship or direction from someone is just so important, because you can spend so long making so many easy mistakes, and you're always going to make them. But at least if you have someone guiding you or giving you a blueprint, you should be able to identify when you're making them earlier and hopefully stop them. And so, I learned so much of those two guys. Over the time I subscribed to Mark's website now, he puts a few of his trades up and does a great webinar every week. It is quite expensive for newcomers, so that might not suit suit everyone, but there's certainly a lot of decent people out there, and I think it's important just to find someone with an audited performance, and if it suits you, you can start to sort of mimic their style, and then of course you'll adapt that as you go on. But I mean, there's no need to reinvent the wheel here. There's, since Livermore to Davos to Wyckoff to Morales to Minavini to O'Neill, there's not that many deviations in their trading style. I mean, of course there is, but they're looking at the same things: good stories, good charts, pivotal points to buy them, controlling the risk.
That's really incredible. I had no idea that you knew Mark Cook and had traded with him. That's really cool. And I'd like to go back to that point, because you said that you were there, you were on site with him, and you saw him actually trading and how he does things. At what point did you know that day trading wasn't for you? Mark Cook is a day trader. He was showing you sort of how he goes about things. And even though you said it was a very simple, what he does is so simple, you still said that it's something that just still wasn't for you. How did you know it wasn't something for you?
Well, I had day traded before then, and I sat there live trading with Mark, and so I could mimic his trades, and he gave us his 5 or 6 setups. So you knew exactly what he's doing. The time zone was a bit of an issue when I came back to Australia, because he really was the bonds and the E-mini, and didn't move outside of them. That was it. And he was the master of those. It didn't work with my personality. I don't like riding the ticks. I like to be able to buy something, put my stop in or my alert in, whatever I might have, and go and have a cup of tea, or go and do something which isn't just staring at the screen. So day trading was never going to work for me, despite the fact that I'd trained with one of the best guys there is. I don't think I would have been able to make money out of it. My personality would have lent to me not following the system well enough, because if you're day trading, you can't have any deviations from your rules. I think the stock market's a little more forgiving and a little more flexible. So for someone of my makeup, that was where I wanted to be.
And when you were trading with Mark on site in his office, wherever that might have been, is that something that you actually paid for, or did you just somehow be able to form a relationship with him and sort of get your foot in the door that way? How'd that opportunity come about? Because people listening to this, they're like, you made a list of the best traders in the world, and then you sort of tried to reach out to some of them and spend time with them. It's quite incredible that you were able to get that time with Mark. So I'm just curious how that actually panned out.
Well, I've done both with Mark. He's a friend now. I actually nearly got him over here to Australia to come and do a conference, and he was ready to come, but the demand just didn't seem there, which surprised me. I mean, it's just such an opportunity to sit with them. But Mark, when I went over, it was for a pay program. I don't recall the exact cost, but it was between $5,000 and $10,000 or something like that. And then obviously, you can establish whatever relationship you want going forward from there. And there was a couple of us who did that, and it was for a week over there. And yeah, I think it's really worth doing, and you might not have to go to America to go and do it. I'm sure there's some good people here in Australia, but it is just formulating what his daily ritual was and seeing how he prepared every morning. And the same goes for Markman Avini. He does a paid service, and last year went and traded with him. And, just the calmness that you see these guys in, it's a second nature to them. The alert either goes off or it doesn't. There's no stress. It's just that trade works. You're either right or you're wrong on it, and then you just repeat. But I mean, these guys are masters of what they've been doing. They've probably taken that trade tens of thousands of times. So it's just a repeat model.
So with Mark Minervini, what were some of the really big things that he taught you or things that you picked up from him? I know it's kind of a bit of a cliche question, but was there anything that really sort of stands out as being sort of that's the reason why he's a good trader?
Oh, Mark's, I mean, he's just a great trader. He's very mathematical, so he has his couple of setups which he uses. The VCP's a big one, and he'll take that and over and over again, just the same repetitive pattern, and then just how he scales in, scales out of positions, how he's always looking, to be a 2-to-1 trader. So that means he's got to be right half the time, and his average gain has to be twice his average loss. And I think once you work out that, you keep your scorecard, as he used to put it, where you record every trade, how long you're in the trade, what the results were, and you analyze that just religiously, weekly, monthly, quarterly. You very quickly pick up where your faults are. So he, 4 or 5 years ago when I first went over to see him, just really drilled that in, and it helps, as I mentioned, it helps see your own weaknesses. So it's the deviations between making 0% return and 20% return are not that significant if your average loss moves from 10 to 7%. That can have just such a compounding effect. So I think that was a big one. And again, just the discipline. There's just, I don't want to speak for Mark at all, but I just can't imagine him taking a trade outside his system. Like, it just would not happen. So, and same with Mark Cook.
Just a short break here, folks. I want to give mention to our new sponsor, Gemini. Just like I mentioned right at the beginning, Gemini is the world's first fully regulated and fully licensed Bitcoin exchange for individual traders and investors, as well as institutions. So with regulatory oversight, you know full well Gemini have a real commitment to ensure clients' Bitcoin stay safe and secure. Also, for algorithmic traders, you may be particularly interested to know Gemini provides a full suite of API connectivity options which you can leverage and test your trade ideas with. But to learn heaps more about Gemini and trading Bitcoin, all you need to do is visit gemini.com/traders and register to get a month's worth of trading without fees. And take note, their client service team is available around the clock to assist with any inquiries and questions. Just to repeat, the link to visit is gemini.com/traders. Gemini being spelt Gemini. Something you said to me, again referring to a conversation we had prior to this call we're on right now, you said that probably around about 80% of mistakes that particularly newer traders make are avoidable. Why do you say this, and how are they avoidable?
Well, I guess the big mistakes for a momentum-based trader such as myself is you should be able to buy at the danger line, so at the point where the trade becomes active. So, I mean, if you limit your buy above that point to 3%, so let's say your alert goes off and immediately it's gone 3 or 4%. If you just don't take any over that bracket there, that'll reduce your chasing. And one of the big things which affected my trading, which really improved my numbers, was violation. So if you do buy it right, and the stock pulls in on you straight away, you'll have your stop loss in play. But what are the only times to get out before your stop loss is triggered? And I still see some guys I talk to a bit about trading, like you'll still see them buy perfectly. The stock pulls in 3 or 4%. They go, bugger it, it's not working. Close the position out, and 2 weeks later it's up 30%. So I mean that's just two ways of just right there of you've bought the thing right, but you're not A, chasing, and you're not B, choking the trade off too early. So you're giving it a chance to work. And so I think most people, as we've discussed already, who go into trading, they've style drifts, so they'll instead of focusing on say that particular setup, they'll be intraday trading the S&P or the Aussie dollar. So, if you don't chase, you stick to your setup, you trade one asset class, don't add to losing trades and don't trade against trend. Right there, you've got a pretty good chance of surviving, and it just comes down to risk management. And I think, most people who have tried to go out or trade on their own, who haven't been mentored, have been told, this is a stock to buy, and they just keep buying it on the way down. And the effect of a stock that falls 50% has to go up 100%. Everyone sort of knows that old adage. So if you get yourself into trouble early, it's quite a big hole to dig yourself out of. So another thing I've found as well, moving back from cash, when you are forced to cash by the market, is just to come back incrementally. So, I talk to people and they'll say, oh, everything looks good again, we'll quickly go 100% long, and that's how you can have big drawdowns happen. So if I'm coming back in from cash and I'm seeing a couple of leading names set up and the index is still going sideways, and then I see a few more leading names set up, I'll try one or two out. And if they're not working, I'm not going to be adding any more positions. So I'll let the market tell me to be adding, rather than just having a view that things are fine now and I quickly need to get back into the market.
Okay, I actually really like that point. So you're talking about in periods where you might not have any trades on and you're entirely in cash, and you start to see some names setting up, you don't just, put trades on every name that you see. You're just sort of slowly building your positions back up. Did I understand that correctly?
That's right. I mean, my system works very much on following leadership. So what are the leading sectors? What are the leading names in the sectors? What's driving the market internally? I couldn't care what the index is doing. If it's under high distribution, I'm not going to be in, and there's pretty high chance that there's very few names setting up constructively. So it doesn't happen. But if say, I remember the index last year looked like it was going to break out through 5.6 or 5.7, I forget, and all of a sudden we had a bunch of distribution set up in the pivot and the leading names started failing. So I went back to cash, and it was another sort of 6 weeks until we got a turn and the leading names set up while the index was still finding a bottom. Tried one or two out, you're up quickly in them, or they go sideways or they go down. If I get stopped out on those one or two names, well, the market's telling me that it's not ready to go, or that my criteria is faulty. And now I don't think that's the case. So it's the market telling me that it's not ready to move yet. And so you can keep, if you're taking a 10% position size, and let's say you've got a 10% stop, you lose on both those two trades, you drop 2%. It's not the end of the world. You can recover from that. But what you don't want to do is go 100% long, get stopped out of, everything pretty quickly and drop 10 or 15%.
Okay. So you're obviously talking about risking 1% of your capital on each trade.
That was just an example. But yes.
Yeah. Okay. So now's probably a good point to actually talk some specifics about your actual strategy. So, just from a high level, how would you describe your style of trading?
I'm not actually sure. I guess it's a momentum-based trading approach where I look for strong sectors, strong company stories, strong earnings, strong revenue growth, and then I will always use a chart to get in. And I only have a couple of entry points. I have the volatility contraction pattern, which is from Markman of Vinny. So if anyone's interested in that, you can buy his book and read about it. He goes in depth about that, and that's effectively a breakout trade. And then I use a pocket pivot, which comes from Gil Morales and Chris Catcher, and then sort of a pullback buy method where the stock is already trending. I've already initiated a position from a breakout, and I'm buying off the first pullback to the moving average when it's obeyed on the uptick. So I wait for the higher close of the previous bar. And really, I mean, well, on the long side anyway, that's about it. that I have, and there's just no shortage of trades to find. So it's never a problem that am I not getting enough stuff setting up. There's always stuff setting up when I should be in the market. If there's nothing setting up, well, that's the market telling me something. So by sticking to this process, you automatically eliminate those times when you shouldn't be in the market, when you should just be sitting on your hands or short if you like to short stocks and can do it properly.
Okay, and we've already established that you're not a day trader, so you probably fit more into the category of what we'd call a swing trader?
Yes, yeah.
Okay, and what markets are you trading? Just the Australian markets?
I trade the US as well. I did trade the US primarily for a few years, but you kind of get a bit worn out doing that now, just because of the time zone difference. So I trade the Australian markets, and I'll run through my US stocks tonight. And as I said, I chat with Markman and Vinny and with Gil and stuff over there. So if they're looking at something decent or posting something decent on one of their sites, I'll have a look, and if I need to put an order on, I will. But probably 90% of my stuff will be in Australia these days.
Okay. And tell us a little bit about how you scan, how you actually go about finding potential trading opportunities, like stocks that are setting up in accordance with your criteria.
Well, you can write code in basically any charting package these days. So I have probably 15 different scans, and I use 4 religiously, and they'll just be looking for basically inflection points. So for a pocket pivot, there is just set criteria. It's you're looking at a 10-day back period for volume. You've got to have higher volume than any down day, and the stock needs to come from below the 10-day moving average to close above it on that volume. So you can write code to find that. The VCP, a little bit harder to write code, but you're basically looking for a pivot. So you're looking for tightness in price and contraction in volume, as well as a contraction in the pattern. So I try to write my code relatively loosely, and then I go through 4,000 or 5,000 charts a day, and a lot of them are the same chart. So I'll do at the end of the day, I'll run all my scans, build watch lists based on how they're setting up, the duration of the base. So I might have 4 active lists, which would move from, potentially buyable in the next 2 weeks to this list will probably go today. And then I'm just adding and subtracting names from those lists. And it's still, there's no easy way in the stock market that I've found. The scans certainly have helped improve. I mean, those old guys that had to go through them by hand or draw the charts, that's real work. But it's just repetition going through. You build your chart eye up. All of a sudden, you just see that pattern that, based on your scorecard is a good pattern to take. And so that's what I do. So I do that every night. Then I'll go through them in the morning with a fresh eye again, see if I've missed something, and then put my alerts on, and then, sit down at the desk and watch a documentary and wait for the alerts.
Okay, so just so I understood that correctly, you're not manually looking through 4,000 to 5,000 charts. That's how many sort of tickers you're feeding into your scans. Is that right?
I'm manually going through them. So you can scroll. I've talked to people about this, and they didn't actually know this existed, which I find crazy. But just the scroll button on your mouse, I can scroll through 50 charts in probably a minute and a half. So I'll just have them set up on the daily time frame and the weekly. I'll have 50 on each list because that's the max the list can provide from the software, and I'll just scroll down those 50, and it only takes 1-2 seconds to look at a chart to know if it interests me. And so most don't. So, and then it's just going through maybe them again in a day a couple of times. But yeah, so it is still a manual process. And then with the fundamental filter, there's better software in the US. The Australian market doesn't quite have the Market Smith platform or the HGSI platform where you can sort of scan for certain earnings and earnings increases and return on equity and cash levels and all that. So we just wrote something in Excel which pulls data from a provider there, and that'll help identify to us what sectors may be having the highest revenue lift, or what companies are having the biggest quarterly increases in earnings or revenue. And as I said, then run them over, put them through the charts, and if they're not ready, they're not ready. If they are, they go to one of the watch lists.
Okay, so are you using Excel only, or are you using an actual software charting package too?
Excel's just to pull the fundamental numbers. The charting packages, I know TradeStation are a sponsor with you. So we have TradeStation, I've got CQG, I've got Pro Real Time, I've got a few. So you can write, it doesn't matter what system you write it in, they're sort of, they're all the same. And then you just scan for them and it'll pop up a list, and you just got to click through them.
So if we were to look at your chart, if we were sitting in your computer chair right now, looking at your screens, what sort of technical and indicators and technical analysis would we see on your charts? I'm
just really a price and volume person, and so I don't really look at RSI or MACD. I do have an MACD just for my intraday when I'm moving into a position, but for me, really, all I need is price and volume and moving averages, and I use the moving averages as reference points where a stock should be accumulated from, where the base or where the price in the base is sitting. Is it sitting on top of a moving average? Is the price chopping down through the moving average? Because when a stock's trending, institutions will be buying it, so they'll normally be holding a certain price point, whether that be the 20-day EMA or if it's trending hard, the 10-day. And that also gives you a reference point to trail a stop, or if you think that immediate term trend has shifted or changed. So yeah, it's pretty simple what I do. It's volume analysis and price analysis and base analysis.
Okay, so once you've identified a name which you see as a trading opportunity, what actually serves as your confirmation signal to get into a position?
So I'm normally using a pivot point. So most setups that I'll buy will have a contraction through the range. So if you think about it like a cup shape, like what you'd see on a cup and handle, I really want to see at least 2 cups, if not 3 or 4, with each cup getting smaller as it moves to the right of the chart. And through there, I want to see the range of price also contract. So it should just look like 3 little mini cups coming into each other, because that's telling me that the supply is diminishing. So there's not so many people willing to sell their stock at that. So the weak hands have been weeded out. I'm only buying uptrending stocks. So you're going to have less of, likelihood of that really bad news result. I'm not buying stocks that have ever had a gap down in the price. I just stay away from them. And then finally, when the stock is setting up, for me, it should have a big dry up in volume, and the price ideally just goes super tight for a couple of days. And that might only be one day. It could be 3 or 4 days. And then I'll just set my alert above that little pivot point. And when that goes through there, I'm buying.
So you set an alert and then you put an order in once you obviously check it out and see if that's something you want to be in. You don't actually have orders waiting in the market to catch that?
It depends on the stock. A lot of the smaller stuff in Australia, it's too risky with the spread. And a bigger stock, obviously, no problem. But no, I generally manually put it in. I still have that discretionary opinion where I'll look and go, right, yep, that's ready to go, that's not. And so, the negative of that, I guess, is if you get multiple signals at a time. But, I mean, that very, very rarely happens. So my computer will just start beeping at me, and and that's time for me to to start pressing a few buttons.
Right. Now, I might just mention, it might be helpful for those who are listening and actually want to visualize some of these things that we're discussing here. So you post a lot of these setups and a lot of charts on Twitter. So I was going to suggest if you want to actually see what this looks like, sort of struggling a little bit to visualize it in your head, check out your Twitter feed. What's your Twitter handle?
It's at Rolly, ROLLY Trader.
Okay, excellent. At Rolly Trader. Now, just still on the point about entries, what happens if you miss your ideal entry point?
As we discussed before, that's something that'll be in my trading plan, which is another thing I think you have to have. So it's basically a rule book for your trades. And it was something that Mark Cook just drummed into your head. If you don't have one, you won't survive. And I think it's very true. So for me, if it goes 4% past there, it's off the table. I just won't take it. So it's as simple as that. And often you'll get a pullback, what I would call a pullback buy, where the stock breaks out and then it'll pull back and to retest that breakout level. And so I'll keep it on the watch list and, be ready to buy it potentially off another setup that happens during its run. But, I'm not going to chase anything.
Okay. So if prices moved more than 4% beyond your actual ideal entry point, you leave it. If it comes back into that zone and retests the breakout point, then you may consider taking an entry then.
Yeah. If what I want to see is I don't want to ever buy on weakness. So if it comes back in and tests that breakout point, I'm waiting for the next day for the close or for the intraday to be above that previous day's high.
Got it. Okay. Now, how do you determine your risk and your position size for each trade that you put on?
Well, there's a formula called Optimal F, and if you put in your trading stats, that'll tell you the optimal position size you should be taking based off your performance. But for me, generally, broadly speaking, I don't like to trade more than 8% in a position, and that's on the initial position. If I'm in a name that goes up quickly, obviously that will increase your exposure just through its return. But I will go up to 20% into one stock if I get multiple setups in there. But just how the market's been the last couple of years, it's been very choppy. It hasn't paid to pyramid your positions. It has been more of a swing traders market. So that's pushed me back. When there was some stuff trending in 2010 and 11, 12, my approach was slightly different. And you've just got to adapt with the market. I mean, you have your trading rules, but they have to be adapted because the market's dynamic. And it's not the same. It changes all the time, but, yet the character remains the same. So you can operate with similar setups and similar criteria, but there's right and wrong times to implement those criteria.
Okay. And I just want to clarify something. When you said that, when you mentioned 20%, that doesn't actually mean that you're risking 20% of your capital, does it? Oh, no, God, no.
Well, I guess effectively you are if it announced something and went to zero. But no, my average stock will be what is about 6.5%. So, if let's just call it 10% to make it easy. So if you're taking a 10% position size, your risk with a 10% stop is 1% of your total capital. And I think that's a good place to start. You probably want to be between 0.5% and 2%, depending on your experience and your trading style. But if you go too much smaller, it's hard to make those big gains. And if you go bigger, you're asking for trouble because you're going to have that occasional stock that gaps down on you, and you're of course going to have a lot of losing stocks. So controlling risk is the number one factor, I think, in a successful trader. Anyone can work out how to buy a VCP or a pocket pivot or anything like that. But if you don't control the risk and don't know how to incrementally scale in and scale out of the market, you're going to deal with big drawdowns.
Yeah. Now you mentioned, or you brought up Optimal F as a formula for having sort of optimal position sizing.
Yeah.
Where can we find out more info about that? What is Optimal F? I've never heard of that.
I'd just say Google. I use one through Mark Minavini's site. He has a calculator on there. And so if you put in that your average gain is 15%, your average loss is 7%, and your win-loss ratio is 50%, and your target is to make a 50% return this year, it'll say, well, you'll probably need to do 80 trades at 11% position size or whatever it is. So that's just a formula. But I mean, you probably don't need to get as complicated as that. I think, the general rule of thumb is probably 5 to 10% for most people that you see on what position size as a percentage of their portfolio they should take. And then, your risk obviously depends on what nature of stock you're trading. A lot of people in Australia trade the really micro cap names, and, they award good returns, but, the spread on them can be 10% alone. So it's hard to be a real risk manager when the bid and ask can stop you out. And I think that's another pitfall of new traders, is to go into those penny stocks. You're better to trade the leading names and develop your skills, trading the Domino's pizzas or the mid-cap leading names, the aristocrats, and you're not going to get the big moves. Well, Domino's probably proves me wrong there, but you're not going to get them so quickly. And I think a lot of people like that gambling feel where they go into a 1 cent stock and it goes up to 2 cents, and they think they've done something right.
Yeah. So just going to the other end of the trade now, how do you determine your exit points?
Selling's very, very hard. It's something I'm certainly work in progress. But for me, again, your average gain will dictate a lot. What that your scorecard says that you make, and also a multiple of risk. So if I'm risking, call it 1N, and which might be 5%, and all of a sudden I make 20%. I'll definitely be selling partial into that. And then it depends on how quickly it moves. If it moves up 20% and then in 2 or 3 days, I'll probably sell a big portion of that into it. If it's a nice orderly chart and slowly drifting up, I'm probably adding to it. And then finally, to get out, I'll use a moving average. So that will depend on the trend of the name I've bought. If it's holding the 20-day on the first test, and then it breaks down through it on its second test, that's when I'll get out.
Okay. So it's fair to say that your exits involve quite a bit of discretion.
Yeah, they do. It depends on the nature of the market. I mean, a name, for example, that I've been tweeting a bit lately, that IIL and CIA, that was a power play setup, which is a particular setup where the stock moves 100% in less than 8 weeks, and then has a base less than 25%, and then resets up a base. So most people think it's way too extended, but it's actually quite a good probability trade. So we're buying that CIA at 50 cents, and it just ran straight to $1 in probably the last week. So I was actually selling a bit today, and I sold a bit 2 days ago, and there's sort of no rules there. It had 3 gap ups in a row, and it's just moved so hard, and so I'm just going to bag some and let the rest ride. Ideally, I want to move my stop to break even as soon as possible. So if I'm up 10% in a trade, I'll just try to reduce my risk immediately. So bring the stop up. If it moves up 15, 20, I might sell 25% of. If it forms a new base, I'll just add back. I'll buy more. So again, it's just incremental selling, incremental buying, reducing risk where I can.
Well, sounds like a good trade to be in. Well done. Now, you said a little earlier, or you hinted that most of your trades are on the long side. I'm interested to hear the reason for this. Why do you prefer trading the long side and rarely trade the short side?
There's been a few occasions I've been on the short side in the last sort of 3 or 4 years, but I mean, we're in a bull market. Well, certainly in the US. The Australian market, there was a great trade, short resources, until probably a year ago, a year and a half ago maybe. I'm not as good at shorting stocks, so purely my scorecard tells me that, so I'm not going to focus on it. If the market comes under distribution and I'm forced back to cash, again, by keeping a leading names watch list, the best names to short are the former leaders. They're the ones that will break down the hardest because they're the ones that have the most froth in them. So if I'm looking through the list there and they're all looking like they're going to, continue falling, I'll move in on the short side. But it's not something I want to be doing. I don't have any short positions on at the moment. It's not something when the market's giving on the long side that I want to be doing, just purely for a state of mind thing and purely because the reward for me is not there. And I'm not one who hedges out my portfolio. I mean, very rarely will I do that. Maybe if there's a big event coming, I might, use a few options or take an index position, but that would be once or twice a year.
Okay, so really what you're trying to do here is just focus on your strengths, ignore your weaknesses.
Well, I'm working on the weaknesses, but I'm working more on what makes me money. There's no point trading something that's not going to make me as much money, even if I'm better at trading it. The market, especially the US, it's a strong uptrend. So I don't think you need to be on the short side unless you're probably a shorter term trader than I am. And absolutely, nothing wrong with trading short, and those people are good at it. It's great, but it's just not one of my strengths. So it's not something I avoid, but it's something that just doesn't happen as a large percentage of my trades.
Yeah, makes sense. Now, stepping aside from trading, something which you have done, which I'd like to ask you a few questions about, is you've actually taken some of your trading profits and you've put them into venture capital. What attracted you to venture capital?
I've always liked, I guess, how business operates and being involved in small businesses. I've got a few friends that have, been pretty successful as entrepreneurs, and I guess when I was an analyst and working on in the different side of the market, you'd meet so many company management spokesmen for the company, and you'd hear their stories, and some of them, were great stories. Some of them you could quickly identify probably weren't going to amount to too much, but it always intrigued me to see how the business actually works under the hood. And just, I guess, by chance, I got into the first one and brought a couple of other people in, and it was a friend developing a business, and he was asking for some advice, and I said, do you need, some capital? And he did, and that business is ticking along. We're sort of up to 80 staff now. And 2 of them I've started myself. And the others, again, are just opportunities which I've seen, which all of the ones we look at have an idea to IPO, or, well, ideally to IPO, but they're products which potentially have that appeal and have that exponential growth. So like any startup, they will require capital, and some will fail, some will succeed. So similar to the market, it's just trying to identify the good ones and stick with them, because you're going to get your bad ones. There's no doubt about that. So we've got 5 businesses now under there, and they're all alive at the moment. maybe next year I can report in and tell you how they're going.
Yeah. Well, are there certain types of businesses which you prefer to invest in?
Well, certainly what we have invested in has been, they're all very different. One's property, one's equipment hire, one's a stock market, one's fashion, and one's in agriculture. And so all pretty different industries, but they're all connecting people. So I guess they're all this new world technology. Either one's AI, one's just aggregating all the suppliers and tenderer options. So it's just, I guess they're just all trying to make it easier for company management to operate. So we're trying to find them a solution at either no cost to them or very little cost to them, and then something they can roll out through their businesses. And it certainly seems to be the new way forward, is especially with AI and how it's starting to now come in. Is 10 years ago people thought Webjet was an out there, or 5 years ago, whatever it was an out there process, and having one website which shows you all the flights and where they can go. And I mean, in a few years' time, it's just going to be a chatbot or a personal assistant on your phone, which you tell, and they go and source that data for you. So maybe we're just building products for the lazy man, but we'll see.
So is that intentional, that each one of these businesses is in a totally separate industry, or is it just kind of worked out that way?
No, it's probably more just worked out that way, I think. But I think probably in the small business world, you're either very specialised and have a big company, or especially in the more venture capital model, you're probably a little bit more diversified. Right.
And have you noticed any big similarities between trading and venture capital?
Well, I mean, it's all just risk reward. So I guess that's a very obvious one. The liquidity of the stock market is just it's a gift. People probably don't appreciate it enough. The ease, especially if you're a small account, if you're under $3 or $5 million, just your ability to come into a position and out of a position in minutes is just huge. You can, as we've discussed, just move back to cash, take some time off. You can regather your thoughts. And in the private business world, you're stuck there, and most of businesses require multiple capital injections. So, you've really got to make it work, and there's more often than not never a liquidity event. So there's certainly different mindsets that you need, and we've got good managers who run all the businesses. So that's, they take on that burden more than I do.
Yeah. And that's a very good point. I mean, I recently sold a property, and I remember saying to my girlfriend, I was just like, the process you've got to go through to sell real estate is ridiculous. Like if I wanted to sell, a few $100,000 worth of stock, I could literally do it within a minute.
Exactly.
In real estate, that whole process drags out like 3 months pretty easily. So I think that liquidity of trading is of huge appeal. Now, you said earlier that you have plans, or it's kind of in the future to IPO some of these companies. That would be the ideal situation. What's the process involved in actually getting to an IPO, and what's the incentive of doing so, of going from a private company to a public company?
The process, we've got one now, I guess you would call it, in the process. So you meet a few brokers or corporate advisors, and they either like and believe in the story or they don't. And assuming they do, you might do a pre-IPO, which for the transition from a private to public business involves quite a lot in terms of compliance. So you might need X amount of new heads come in. So you might do a pre-IPO to be able to fund that, and get all your, everything audited and get everything looking correctly. And then you move through it. It takes about a year. if you're doing the pre-IPO or 9 months. And the benefit, I guess, is access to capital, especially with companies that have a lot of potential but require a lot of money to get there. There's only so much help that the founding shareholders can do, and we've had a few external capital raisings for the different companies, and it's a very hard, long process. We were probably a year doing a raise for one of the businesses, and it really took the MDs a lot of their time. And great, we got it away. I mean, it's fantastic, and the company's growing quickly. So I guess a liquidity event for shareholders, the chance for new shareholders to come in who believe in the story, and the access to capital to grow the business. So I guess that those are the defining features.
Yeah, no, that's good. And so how does a pre-IPO work?
Well, you might just go to whatever broker it is, and you might say we want to raise 4 or 5 million on the IPO, and we might need $500,000 or $1 million, 6 months before, in order to employ, maybe a professional chairman or a director who's got a name in the industry, do your compliance, tidy up a few things. So it's really just a little bit of teething money, so you're ready to hit the market properly, because there are those additional regulations and the cost of actually IPOing and doing all that. So, if your business is flush with cash, you might not do a pre-IPO. But if you need a bit of tidy up money or expansion capital, that's something you'd do. And normally that might be sort of a 6-month window until the IPO, and those people who come in at that level are normally given the shares, or they purchase the shares at a discount to what the IPO will be, and that might be 10 to 20, 25% for taking on that additional risk.
Right. Okay. Cool, man. Well, let's leave it at that. Where can listeners go to find out a bit more about you? Is there anything you want to share? Is there anything you're working on? Give us the lowdown.
Well, one of the new companies I've been building, it's called Suubee, Suubee, and what we're trying to make is a new way to access financial information for stock traders in Australia. So I'll be providing every trade I do through there. There'll be lots of traders that I'm sure some of your listeners follow on Twitter who'll be doing that. We'll be having trader meetups, discussions, really just trying to build a new platform to help educate and train people, and for traders to watch someone trade and learn their style and eventually be able to mimic it. So we've been building that for the last 2 years, and we're in beta at the moment. So we're hopefully we'll be launching later on in the year. But there's a web page up just for expressions of interest. So if anyone wants to really see what I'm doing, I mean, I'll be doing everything through there by the time we open. Otherwise, I'm just on Twitter.
Okay. And do you just want to share your Twitter handle one more time?
So it was at Rolly Trader.
Okay. And that's ROLLY Trader.
That's right.
Excellent. Well, thank you very much for coming on. It's been really great speaking with you. And thanks a lot for agreeing to do this.
Thank you very much, Aaron, for including me, and look forward to having a chat soon.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.